Can everyone hear me? As people are trickling in, we'll get the meeting started pretty quick. Hi, everyone. As people are trickling in, we'll get this going pretty soon here.
You want us all on mute or?
Oh yeah, please. If you could leave yourselves on mute, that'd be great. It was supposed to do that automatically, but.
Hey, so how are you, brother?
Hey, how you doing, Amit?
Good, man. Good, good. Should I leave it muted for now and then just?
You know, yeah, sure. If your office is not that noisy, it's just fine. Just leave yourself unmuted.
Yeah, sure.
I'm just gonna see where Troy is and Richard. So how's everyone doing?
Oh.
Hey, Troy, we got Troy. Okay, perfect.
Pretty good.
Awesome.
We have a quick look here. All right. Some friendly faces, some new faces. We got some people waiting. Okay, some more people joining. I have to keep admitting people to come on. I thought it was going to do that automatically, but I'll keep on doing that. We'll wait a couple more minutes for everybody to join and we'll get this thing going. I think Troy and Emmett are the only ones currently unmuted.
𝗖𝗣𝗜
Okay.
I think Troy's is muted. No, there you go.
Yeah.
Hey, August, how you doing?
Good. Who's
Finally put the face to the name over here.
Hey, how you doing, man? Good, good.
Good, good.
Let's
Really
put
cool of you to set this up.
For sure. Let's everybody go on mute if you could, and I'll get this thing going so there's no interruption, and we'll get our speakers to jump on and have a talk. Oh, Rich, oh no, we got that here. Okay, great. All right, we got a fair amount of people on board. All right, everyone. Hope all of you are healthy and safe, yourselves and your family. These are definitely unprecedented times. Our world not only is changing, I believe it has changed for a very long time to come. And let's have a discussion about how this is going to affect the real estate market. So I'll just quickly go over the meeting agenda here. We have a couple of speakers who are going to be speaking tonight, including obviously myself. They will get on shortly and give their perspective of about their business in real estate and how that's being affected currently, and we'll go from there. So I'll give everyone a quick background about myself. So I'm August Biniaz. I'm the founder of Canadian Passive Investing. We are a private equity real estate group. We invest in multifamily apartment communities in the US. So our group is currently obviously taking a back seat. Okay, we have Richard on too, great. So Richard is here. And yeah, so A quick background about myself. I've been involved in real estate in one form or other for the last 15 years. I started out as a real estate agent, moved on to do fix and flips, small renovations when you renovate a project and you sell it. I moved on from there to create my own general contracting company, White Rhino Developments, and I've begun building custom homes. I was a builder for hire, so people hire me to build a home for them. I was also a developer in the sense that I would buy a project, build a new home, and would sell that. As time went on, I started bringing on investors to invest with me, family, friends, business associates. I would find a project, bring on my investors, and I would be the general contractor on the project. I would build it and we would sell it and share the profits. I knew I wanted to scale. I wanted to move on to a bigger project, so I moved on to, I raised capital to buy a townhouse project, and from there, for the townhouse project, I wasn't the general contractor. I brought on a general contractor, so I had more time doing the other important things. So I was a development manager for the project. The issue I was having with these types of investments, a development project, was that my investment and my investors' investment would be stuck for the term of the project without any of us receiving any kind of returns. So I was looking for another type of asset in real estate. And a year ago, I was got in touch with someone by the name of Dan Hanford, and what he did was they did a very similar system. They would find projects and raise capital to purchase these projects, but they would purchase cash flowing apartment communities. There was a small value add component within these projects where they would go in and upgrade and do small renovations to increase the value. But the risk was very low because it wasn't a full-on development project. So I fell in love with the system, and I started growing my team and created my own group. And we were in the process of purchasing our first asset until this situation of COVID-19 hit. So that's a bit background about myself. From there, let's see here, go over my notes. Yeah, so the meeting you guys are part of today. So this meeting is my regular meetup Monday. Every first Monday of the month, we have a meetup for multifamily investing in the US. It's a educational and networking event. Obviously, because of the situation, we can't have a in-person meeting, so we're having the meeting on Zoom. Also, you know, I've invited a bunch of other business associates and friends on as well. So it's a mixture of my meetup group and other people. So just want to give everybody an update on that. And yeah, maybe I'll quickly get quickly get Amit to come on board and have a quick discussion. So Amit, if you want to get on, let people know. Amit is a mortgage broker. So I wanted to bring someone on to have a discussion about the lending as how it's being affected by the market and what are the banks doing and what changes are taking place, and get someone from a lending side's perspective on the situation. So Amit is a mortgage broker. So if you want to let everybody know a little bit about yourself, Amit.
Yeah, of course.
Also, sorry, one more thing is just write your questions, and if anybody has any question and you're on mute, please go ahead and write your questions in the comments section. It says chat, and tag the name of the speaker. So if your question is for me, just tag my name. If it's for Amit, just put his name so we know who you were asking the question from. And when he's done, when we're done our talk, then we can jump in and ask the questions. And
should we go into everything entirely, or just introduce myself?
Yeah, just give a quick background about yourself as
Yeah. So my name is Amit. Thanks for that. And so not too extensive. I mean, I've been a broker for the past 3-4 years now, about 3 years now, and I've seen quite a few changes already since then. over the past 10, 15 years, my family, we've had a business of our own doing a lot of private lending. So we've seen how the ratios, interest rates, and sort of lending criteria have changed over time, and sort of seen how catastrophic this event has been. Not necessarily directly on real estate, but in terms of the world economy and the commercial business. So I've been brokering for the past 2-3 years now, and I focus a lot on private lending. So that's a lot on equity lending, where lenders mainly look at properties and rather than looking at income and credit levels. We also do lots of bank lending as well, credit union lending, and working with all sorts of money lenders. And so it's been quite a big few years, and I think there's still so much more to come. But
Perfect. Yeah. So if you want to tell us a bit about this situation, the COVID-19, how has it affected your business? What have you seen? Any kind of conversations you've had with other brokers, underwriters, bankers about this thing, to give us kind of an idea of behind the scenes of what's happening in the lending world?
I mean, directly in my business. So like I said, I do a lot of private lending. So from what I've seen is a lot of the lenders are looking to sort of restrict their lending, right? So normally, what we would normally see in a market is where a lender would go to refinance a property up to 80% of its value. Majority of the lenders are now scaling back and putting that to 70%, maybe 75% for the more high riskier ones. I've also seen banks sort of not really change their lending criteria, because banks like to sort of lend on income and credit and then individual history of the applicant. So what they've done is just sort of verified that people are actually working their jobs. So they'll make multiple phone calls to verify that. I also work with a lot of developers. And so what I've also seen on these large land purchases are that banks are sort of limiting their land capital. This includes institutional banks and modeling lenders as well. And so what I've seen is that a lot of them had to make the shift to private lending, and that's where interest rates get a lot higher. And so that's sort of been directly what I've been seeing in my business since COVID-19 has taken effect.
So I hear both sides perspectives. So I hear that the rates are falling. It's a great time to get a mortgage now. The banks are more relaxed. And on the other side, I hear no, it's actually more difficult to get approved for mortgages currently. So what do you see? What is the truth out there?
Yeah. So a lot of people are getting a misconception that because the overnight lending rate is getting cut, you'll see a lot of news, especially in the past 2 months, where the Bank of Canada has been cutting the lending rate by quarter, by half a percent in multiple stages. So what's actually happening is, yes, the overnight lending rate is getting cut, but that is the bank's overnight borrowing rate. So what they're doing is essentially keeping their mortgage rate still, but the overnight lending rate is going down. So essentially they're keeping onto the profits. So in one sense, people with variable mortgages, their rates are going a lot lower. So refinances are going up. Whereas people that are looking to get fixed mortgages, theirs are still hovering around that 2.8 to 3% range. At one point, it did fall to 2.2 and even 2.3, but for the most part, banks wanted to hold on to a little bit of the profit because they're having liquidity issues as well.
Great. So that's a great segue there. So if someone has a variable mortgage currently, your advice would be to keep that at variable, not to fix it, or what would be your is everybody still there?
Sorry, something just happened.
Something just happened.
Somebody just took over the screen.
Oh, okay.
Yeah, 1 second.
I don't see anything. No.
Someone mistakenly shared their screen. I think
Okay.
that's what happened.
Let's just quickly see here.
Okay.
Oh, there you go.
It's back.
There you go. Yeah.
It's good. Yeah, I'll do it right there. So we got.
Yeah.
Right.
Are we good? We're back on.
Yeah, I think we should be good, right?
Yeah.
I think I removed it, so I hope they try to get back on. So yeah, so you were saying, so if someone has a variable mortgage currently, the advice is for them to keep it on variable, and yeah, please talk about that. And also, if someone,
I mean, in short term, it really depends on when your refinances are, when you're looking to sort of renew your mortgage terms. Because from my opinion, what I've seen is in the short term, it might be smart to hold on to a variable, but as time goes by, as the years go by, as COVID-19 sort of recovers, what we're going to see is sort of a bit of an increase in interest rates. And the reason I say that is because the Bank of Canada has injected so much capital into the economy to sort of stimulate the market. We saw interest rates fall drastically. So this is only my opinion, and I feel that over a few years, the banks are going to start to, or even the Bank of Canada is going to want to start holding on to their profits as well, right, and making it back what they sort of injected into the economy. And so over a couple of years, we may see spikes in interest rate levels. So at the time right now, yes, it may be smart to get a variable rate mortgage, but if your refinance is coming up in, let's say, 1 year, maybe 2 years, it may be smart to just lock in a 5-year fixed and sort of take away your risk there.
Got it. Great. So a couple other questions here. As far as anybody who's in the market to get mortgage, and you primarily work through with private lenders and what have you, so like bridge lending and what have you. So do you see a trend, or have rates have gone up? Like what's happening with us? Not the Bank of Canada,
Yeah, for sure.
but the private lending.
Yeah. So what we've seen in the private lending space is that not necessarily have rates gone up. Fees have still been the same as well. There's a lot of fees, not a lot, there's some lender fees associated with getting private mortgages as well. Fees have stayed the same, interest rates have even stayed the same. What's changed is two things from what I've seen. Number one is a decrease in the loan to value. So whereas I said before, if a property is worth 1 million, normally the lender may have loaned up to 800,000, which is 80% loan to value of the property. What they've done now is sort of scaled back to 70%, so only a $700,000 loan. And the reason for that is essentially, what if the real estate market falls within the next year, 10, 15%, right? They don't want to increase their risk there. So I haven't seen interest rates change much. And another thing, number two would be an interest reserve. So essentially what an interest reserve is...
Can you go into detail about that? Because that's a very important item. That's across the board here and in the US, with all types of brokers I've been speaking to. So go over a little in detail about this item here.
About an interest reserve, or was that loan to value?
Interest reserve, please, yes.
Interest reserve, okay, yeah, for sure. So essentially what an interest reserve is, and a lot of private lenders do this, is because a lot of borrowers are lacking income. So what they do is they sort of guarantee their interest upfront, in a sense. So if I can give you guys an example, let's say we have $1 million property, and the bank's looking to, or sorry, the private lender is looking to loan 80% of the property's value, so that's $800,000. If that mortgage or that loan has a 10% interest rate, that's a per annum amount of $80,000. So what they'll actually do is, instead of loaning you 800, they'll loan you 720,000. So they're basically taking the year's interest upfront, and they're holding it in their lawyer's trust, and they take payments out of there over that year. So what helps with this is that the borrower doesn't have to make payments, and the lender doesn't have to sort of follow to collect payments. And it's helpful in today's market. Why? Because people aren't working anymore. Commercial businesses have taken a hit. So the next 6 months or 12 months are unpredictable. And so a lot of lenders want to hold on to that interest reserve to sort of mitigate the risk.
Great. Okay, wonderful. And I think we got a question here for you in the comments if you want to touch on that. Actually, you know what? Let's hold that question for a minute. So what I'm going to ask all the speakers tonight is kind of give their totally opinion. So don't be going and doing anything on these items. Like, kind of give us your opinion on what do you see happening with the market? What's your personal prediction in what you've seen, your professional opinion in your field? Where do you see the market going, and as far as the prices, as far as lending, as far as the economy in general?
Yeah, for sure. In general, what I see is, I mean, we've already seen, I believe, a 50% drop in sales since the month of April. I think they're just released today over the weekend, and so what I'm sort of predicting is even though sales have taken a large hit, I don't believe that the prices will get dropped that much. And that's just sort of my opinion. I think it's up again that the value will still hold. When because we're in a situation where demand hasn't gone away and supply hasn't gone away. It's just on hold. Open houses aren't happening because of course COVID-19, and so in my opinion, short term, I think it'll just be steady, and maybe long term, when there's changes in interest rates, that'll happen in the sales activity.
Got it. Okay, great. So yeah, let's get to some questions here. If you like.
Sure. Yeah, sure. We can answer them all at the end, or we can do it right now. It doesn't matter.
Yeah, go ahead. Just go ahead. You can see the questions, obviously.
Yeah, I got it here. So we have one from 𝗖𝗣𝗶. Have you seen any trends of lenders changing lending terms significantly? And would this be so? If we look at private lenders, it's similar to what I just mentioned. So they're just pulling their LTV. There hasn't been major changes in their terms, aside from their LTVs and their interest reserves. A lot of lenders are actually shying away from doing land mortgages, and so institutional private lenders, individuals, have become a very popular option in today's market. And so we haven't really seen much in terms of changing in whether they're lending or not. Lenders are still lending. Their loan to values and sort of where they're lending has almost sort of shifted a little bit.
Okay, great.
And so I'll move on to the next one there. I see this your screen right now. Is it possible to lock in a lower interest rate on a 5 or 10 year horizon right now? Yeah, it's possible. I mean, for example, like the 5 year fixed right now, without getting too much into deals, so I just finished one last week. It was 2.84% on a 5 year fixed, which is relatively good for the next 5 years. If you're looking to live in your house and not looking to take on any risk or a potential increase in interest rates, it may be just beneficial for you, depending on what type of borrower you are, to lock in now. Some people have an appetite for risk. They may be able to hold on to a variable under 2.5% for a longer term. So in my opinion, I mean, it depends on the borrower, it depends on the risk levels. If you want to stay safe, yeah, it might be smart to lock in to a 5 year.
Let me ask you a question about that particular deal that you worked on. So 2.85, 5 years fixed. Pre-COVID-19, what would the same kind of file be as far as the interest rates go? What would be that? Kind of give us a difference between post-COVID-19 and post-COVID-19.
Yeah, in terms of. Sorry, I think my Wi-Fi is just being a little annoying right now. 1 second. Yeah. Okay. Yeah. I mean.
The video is kind of stopped. So I can hear you.
Okay. It feels like it's scratching out there. Okay. Yeah. But yeah. So the one we just did was a 2.8. It was a 2.84 5 year fixed. And so, from what I feel, mortgage rates have been a little bit shifty. So they've also gone up. They've also gone down as well. So we've seen as low as when the first 2 weeks of COVID-19 hit, we saw as low as 2.39% fixed or 2.29% fixed. Even 2 weeks after that, we saw as high as 3.09% fixed. And during this period, which was close to the end of April, I guess we saw a little bit of a more drop because the government of Canada said basically banks shouldn't be eating at the profits that we're lending lower rates at. So it's been fluctuating so far within the past month or so, about 50 bits, which is 0.5 exactly, but they've sort of been just up and down the past little bit. That's what I've seen personally.
Okay, perfect.
Yeah.
We'll just take one more question and then we can move on.
Yeah, sure. Let's see, are you talking? Yeah, so this was for Richard. Yes, I was talking about markets in terms of private lending. That's what it was.
So we got all of it. Okay, great. Thanks. Yeah. If you'd like to share your information on the comment box,
yeah, sure.
I want to get in touch with you if they got questions in regards to.
Yeah, and if there's any other questions, don't hesitate to just write in the comment section. We can answer it later on as well, but we'll let everyone
Perfect. We'll get you back on if you have to answer those, but put your information in the comment.
Yeah, of course. I'll do that.
Now, I'll bring on Richard. So Richard is, I'll unmute you, Richard, here. And maybe I'll mute you, Amit, just to have you. Hi, Richard. How are you doing?
Good. I don't have very long. I've only got about 5 or 10 minutes.
Fair enough.
File that I get back onto. So
fair enough. So Richard is a real estate lawyer. So he's been involved in real estate law almost as long as I've been alive. He helps me on lots of my files. So I thought he'd be a great person to bring on. Just quickly, Richard, what do you see as far as the world of real estate? What do you see happening? Do you see people walking away from deals? Do you see like what is the atmosphere right now? Kind of give us an idea about that.
I think that it all comes back to guys like Amit, because if the financing isn't there, that's when people are walking away from deals. And I have seen a bit of that happening here over the last month or two. There are a couple of deals that I've been working on where people are trying to exit out of deals, and it all comes back to financing effectively. And from what I understand, there's a number of lenders out there that are just, to be quite frank, they're just putting the brakes on things and just saying, nope, don't really want to do anything for the next 60 to 90 days. Let's see what happens.
No, definitely. I've heard that too as well. We had a great conversation a few days ago, and we will quickly touch on this. I'll get your prediction moving forward. We talked about how this situation has affected our world, and you were telling me about your, was it your father you were telling me about, or your father, right? You were telling me about as far as the time of the Great Depression and how it affected them, and they were very frugal in their life, and how we talked about this is going to have this continuous effect for us. We are the generation of the COVID-19 where it's going to affect us for our lives moving forward. So if you'd like to touch on that a bit, that was a great conversation we had.
Well, yeah, I always used to. My dad, he grew up in the Depression, and his reaction to things always was that he would never waste anything. He would, he was very frugal with the way he dealt with things. And of course, in my period of time being on this earth, I always would scratch my head and just wonder how he could be so impacted. But now that I'm going through this pandemic here, yeah, I think that, I'm sure that this is going to have an effect on all of us here as to how we deal with things. It might not be in the same fashion, but I suspect that going forward, we're going to perhaps be a little more wary of things that may bump in the night, right? I mean, the reality is, as a lender, and Amit will probably agree with this, that, I think that there's probably some lenders out there now that are going to basically say, oh, yeah, okay, what happens if we have another pandemic? How is my security going to be affected? And I suspect.
Oops, we lost Richard here. Richard, yep, you're back. You were just saying.
I think somebody was trying to phone in.
Yes, go ahead. Go ahead, Rick. I can hear you.
Yeah. So as far as my thoughts going forward here, I think it's going to take us at least a year or two to kind of come out of this. It's pretty hard to believe that you can stop an economy almost full stop and then just bring it back to life within a matter of months. I mean, I think we're in for a little bit of a haul here, but I got to tell you, and every real estate investor that I talk to, and I talk to a lot because I act for a lot of them, they're all looking forward to this because they believe that there's going to be opportunities out there. This is an opportunity time, and I think that's when investors are going to take advantage of motivated sellers, I would suspect.
Absolutely. Motivated sellers, and also distressed deals. I mean, deals that were not well managed, or deals that were hit because of the occupational demographic of the tenants, especially in multifamily. So we're definitely going to see that it's going to be some crazy times ahead But thank you so much, Richard. Please share your information in the comment box if anybody wants to get a hold of you. Richard does, I mean, a variety of different things when it comes to real estate law, joint venture contracts, incorporations, shareholder agreements, basically anything real estate related. He's the man, and great person for you guys to have in your Rolodex. So
yeah, so I recognize a whole number of the people who are involved in this conversation here tonight. Freeman Yee, it's nice to see you again, and 𝗖𝗽𝗶𝘁, nice to see you again. So I wish you well. I got to leave you. So thanks very much, August, for inviting me.
Thank you, Richard. Have a great evening. Thank you for coming on. Perfect, guys. Okay, so that was Richard. He didn't get any chances to ask any questions from him, but we'll leave that for the next time. So we have my good friend. It's incredible for me to say this, but also my mentor. He happens to be younger than me, but he is my mentor. So things sometimes work in that way. The Swiss Army of real estate, the jack of all trades when it comes to real estate, my good friend 𝗖𝗽𝗶𝗁. Let's get him on here and have a great conversation with Troy.
Hey, 𝗖𝗽𝗶𝘁, can you hear me?
How are you doing, Troy?
Does it sound okay?
Yeah, sounds great.
Okay.
Kind of give us a little bit about your background. Kind of tell us about any projects you're working on currently, and by that I mean the 57-story building, your building application you just put into the city of Surrey. So go ahead, tell us a little bit about your background and anything you're working on currently, please.
My name is 𝗖𝗽𝗶𝘁. I'm currently the director of development for 𝗖𝗽𝗶𝘁 Development. We're working on a variety of projects, kind of in Western Canada. We have a couple apartment buildings that we're working on in Calgary. We have 3 apartment buildings that we're proposing currently in Surrey, 40, 44, and 57-story tower. We're working on tower application in Maple Ridge right now, and we're probably going to do a second tower application out there shortly. And then we're also working on an apartment building right now, currently in Vancouver. I have been working in real estate for 16, 17 years. Prior to working at 𝗖𝗽𝗶𝘁 Developments, I was also involved quite a bit in the not-for-profit sector as well in the industry and outside of the industry. I volunteer right now with West Point Grey Community Association on their board. I was the past president of the Real Estate Institute of BC. I volunteer on the board of directors right now with Built Green Canada and with Fraser Valley Home Builders Association. And I also am involved in the Rotary Club of West Van, also with 𝗖𝗽𝗶𝗁 and 𝗖𝗽𝗶𝘁. They just recently joined us as well. So I have kind of a broad background in real estate development, working and volunteering with not-for-profit organizations provincially and federally to an extent. Yeah, I'm lucky. I'm involved in some interesting projects, and the most interesting one that I'm involved in right now is that tower application in Surrey, because it's an interesting project that definitely will create a lasting impact in the Fraser Valley and also kind of in the Fleetwood neighborhood. And so we're and I'll just kind of jump into one of the questions that 𝗖𝗽𝗶𝘁 had earlier for the other speakers with regards to COVID-19 and impacts on real estate and real estate development per se. I would say I would agree with what Amit had said earlier in regards to access to capital and access to trying to secure financing and also kind of interest rate hits. And further to one of his comments in regards to the Bank of Canada and the kind of purchasing power, as a real estate development professional, when you're looking at a development site or a development play, you need to take into consideration, the lending side of things in terms of how much you'll need to put into a deal, and also what it looks like for your potential purchasers on a project moving forward. Because at the end of the day, if you're working in real estate development, you're only as strong as the renters who are paying rent, or you're only as strong as the purchasers who are actually going to be moving into the community that you're building at the end of the day. So if you're working in an environment that's recessionary, definitely you need to take into consideration kind of all the moving parts of real estate, the mortgage broker side of things, the lending side of things, the housing supply side of things, construction costs and things like that. So COVID predictions for me, I think in the next.
Before we get into that, really quick here. So I had a mortgage broker to give us the lending perspective. I brought on Richard to give us kind of an idea of what's happening with deals. Are people walking away from deals as far as the litigation side of it goes? And Troy is here to give us a perspective, a developer's perspective. So he is the development manager of one of the bigger firms here in town, 𝗖𝗽 Development. So let's talk about, as a case study, let's talk about your Surrey project, the 57 units, or your Vancouver project. As a developer, how has the COVID-19 affected you guys? And give us kind of an idea. Has it affected you as far as the lending side? Has it affected you as far as the pricing moving downwards? Have you guys slowed things down? Have you speed things up? Kind of give us an idea. Kind of give us that view from a developer's perspective, and how are you guys taking in this whole situation? And then I'll move on to get you to kind of give us a prediction and a couple other questions I have for you.
Yeah, just with regard, I'll just use the Surrey project as an example. We put the application in late last year, and we were anticipating that the city would be working forward on a neighborhood concept plan for the Fleetwood, the SkyTrain extension that was going into Langley. The challenge that we have right now is with COVID, you can't perform, like public functions as a developer normally would. Public hearings, community open houses, face-to-face meetings with community associations, business improvement associations, and things like that. You could try to do it virtually, but I don't know. I'm assuming many of you, as real estate professionals, in one way or another, you probably attended, an 𝗖𝗍 or a 𝗖𝗽 or a Pinnacle or another developer's open house just for general interest, or just because it affected you in one way, shape, or form, maybe in the neighborhood that you live. So you can't have an open house right now whatsoever. We were anticipating that we would have had 2 open house events for our Surrey Tower project by now. We were hoping to have a meeting with the community association and the BIA, which I guess we can do virtually through Zoom, but it's just not the same to be able to go to a meeting and kind of roll out a set of plans and kind of mark them up and walk them through like the development vision for the site. And then on the flip side, that's just a developer's perspective on community engagement. The city in itself has to do a series of open houses to the public, outlining the plan, outlining the vision, outlining the goals and objectives for, we're proposing like 1,320 units or something like that. And the city's grand vision for this neighborhood is a 20 to a 30-year kind of rollout of the plan, with SkyTrain stations and billions of dollars of infrastructure investment. And so their process generally takes up to 2 years to get the original concept plan out through to council approval. And what we're seeing is that the city is so far doing a good job coming up with an emergency response plan to COVID. I believe they have a council meeting coming up in the next few weeks, if not in the next week or two, just in regards to how to deal with that situation right now. But they've really had to pivot in terms of focusing on essential services, and then all of the other elements, like the neighborhood plan that we're going into, that's kind of a secondary objective. Their goal is to try and advance the plan so that they don't lose any momentum or any of the timing that they were hoping to achieve, with their kind of 18-month rollout of the neighborhood plan. So hopefully the first wave of COVID-19 kind of tapers down over the next month or two. Some people are suggesting, it might be late May, June, July, for that to kind of taper down, and hopefully the city can accelerate the planning process, because that really does affect our ability to advance our project. We were anticipating it would be a 2 or 3 year time frame to get the master plan and the community and the first phase approved, that's still a reasonable time frame, because it's, we're not looking at months, we're looking at years, and by then there's probably going to be a vaccine for this thing. But it's a challenge for a developer who's looking just simply to invest in a like a tower project or a multi-phase tower project when there's uncertainty with where we're at right now. But I think we're only 6 or 7 weeks going into the pandemic. So at the end of the day, when you look at the grand scheme of things, this is a bit of a hiccup or a road bump for our development application, but we're confident, comfortable that the city will, as they advance through the process, work with us kind of as partners, because we're proposing, I think, one of the larger projects in the neighborhood that's going to be right directly adjacent to a SkyTrain station. We're hoping that they'll see the merit in our application, and whether it's a 57-story tower as the highest tower we're proposing, which it probably won't be. It'll probably be something a little bit more moderate. We still need to work with the city. We still need to work with the community and various stakeholders to come up with something that's more reasonable. But it'll be interesting to see how the city and the public responds, pre-COVID, kind of post-COVID, phase 1 and phase 2, as to how it'll affect us. So
Okay. As far as, quick thing here, Troy, how about as far as prices? How do you guys, when a developer gets into a big project, like a high-rise project that you guys are doing, is there, have you guys had your performer a certain price set? Have you guys thought about changing in prices? Anything like kind of that aspect of it?
I would, and I'm just going to speak kind of broadly on the market right now, and this is just from a development perspective, kind of for Metro Vancouver and the Fraser Valley. There's a lot of development projects that you're seeing in the news lately that are unfortunately stalling, that are affected by changes in lending criteria, affected in changes in consumer sentiment to purchase. There was a Vancouver development recently that was being proposed on Oak Street that I was familiar with, and they launched probably maybe a month ago, and they were hoping to achieve a certain pre-sales test, and they couldn't hit it. And if you can't hit your pre-sales test, you can't hit one of your financing milestones in order to proceed. In regards to pricing, you can always adjust your pricing downward to see if you can achieve a certain sales target. But as soon as you drop your pricing, especially if it doesn't work with your pro forma, then you're kind of stuck at a base price that is just kind of going to bring down or drag down, where you'll be in 3 months or 6 months or 12 months from now. And then lastly, just in regards to the city of Surrey, for example, you're looking at pricing a year ago or even 6 months ago. The market was starting to really take off, kind of late 2019 and early 2020, prior to March. There was a lot of positive stats that, kind of lending on what Amit was saying earlier in regards to where things were moving. And, 6 months ago, you could look at high-rise product in Surrey City Center, maybe at like $850, $900 a square, if not more for smaller units, a little bit less for the larger units on the price band. And now, if you're looking at current pricing, just in regards to sales transaction, even on the resale side on MLS for properties downtown Surrey, they've come down $50 to $75 a square foot, which is a tremendous jump, 10–15%, just in the last little while. But the other issue to consider is there's not a lot of available comps right now for sales, because the volume of sales has dwindled. And if you're trying to get financing as a buyer, like if you look at it from the end buyer perspective, which, like you're only as good as your customers. If your buyers are struggling to get financing because there's not enough active comps, you need 3 to 5 comps to have a satisfactory appraisal. If there's a lack of comparable sales and or the prices have come down quite a bit, your buyers might be struggling, potential buyers in the area might be struggling just even to get financed. And it's something that I think, maybe Amit could speak to as well, just in regards to if the appraisals aren't satisfactory, what the implications are to a buyer, or it changes to the interest rate in terms of purchasing power. Like I would love to hear Amit speak more to that.
Well, for sure. And we'll get Amit to jump on here for a second. So let me ask you another question while we're on the topic. How about on the construction side? Have you guys seen decreased prices as far as your trades and subcontractors that you work with, or potentially? Because that's another thing that I've heard a lot, that construction prices could come down as there is not enough work out there for different trades. If you want to comment on that item.
I think that from a construction pricing perspective, there's a lot of projects that are currently under construction right now that, you know, are pre-COVID that are actively, working through, whether it's excavation, shoring, concrete pours, you know, 50 to 75% of the way through the life of construction. So there's a lot of projects that are kind of 3 to 6 to 12 months in of potentially a 24-month or a 30-month build. So depending on where those projects are at in the life cycle right now, a lot of companies are tied to those projects. So if there's 100 development projects under construction in Metro Vancouver right now, and I'm just using the kind of broad numbers, they're 60% of the way through construction. Like, I'm just, again, using just kind of broad items. If you're looking at pricing to come down, certain trades who are coming off of a job that are, going to be pricing out projects where the job is finishing, 2 or 3 months from now, because we don't know how long COVID will last, and it could last, as long as a year. I think the sub trades that are coming off of a job where they don't have an active project that they're coming onto are going to be aggressive with their pricing. I think the trades that are strong and they have like a long lag time or lead time in terms of workflow, they're not going to be as aggressive because they're job right now and they don't have anything about until the runway runs out for them. So I would say that from my perspective, sub trade pricing come off not right away, unless it's like in a sub trade that's kind of in and out of a job site quite quickly. I would think that maybe 3 to 6 months from now, or 6 to 8 months from now, that's when you'll start to see kind of the pressure. But because there was a lot of commitments that were done, like prior to 7 weeks ago, it's something that I think is going to have to kind of trickle into construction pricing. It's like gas pricing, right? Even though gas has gone down so much, that gas was into the negative price point last week, there's still that lead time for it to kind of hit the consumer. So it's a bit of lead time for it to hit the development community, I think. So maybe 3 to 6 months from now, you'll see it come down.
Great. And now one more item. Your 𝗼𝗜 Developments is also involved in developments in Alberta. And these are two markets that we were watching very closely. The energy sector and markets that were dependent on the energy. So the West Texas market in the US and our equivalent Alberta in that case. And so kind of give us a perspective of Alberta, and since the Alberta market is so oil related, what do you guys see happening, and what are your plans with your projects moving forward in Alberta?
With regards to Alberta, it's a tougher market right now because they very much are a single sector industry. There is still movement in other areas of the Calgary economy, so to speak, trying to diversify their workforce. There's still strong demand for rental because if people can't afford to buy a home, they still need somewhere to live. So from a rental perspective, there's still strong demand out there for that. With regards to new home sales, at the same time, there is some semi-strong demand for rental. There are individuals who would rather own than rent if they have job security. So nurses, doctors, kind of medical care staff, so essential services per se, those sectors are still in a stable economic situation, so they would be looking to potentially buy a used home or a new home or whatever the case is. Some of the markets out there are actually doing quite well, surprisingly. Other markets like luxury condos, luxury townhomes, single family homes that are kind of in B or C locations, it's a little bit tougher. I would say going forward, when the market does start to pick up once, we see, changes in commodity pricing. Hopefully the natural resources sector, gets a bit of a boost somehow, some way, just depending on what those the economic drivers are to push that up. When Alberta does kind of get back to normal, like strong prairie growth, like kind of strong economic growth, which could be 6 months from now, 12 months from now. Nobody really knows how long it's going to take for us to get out of where things are at right now. I do think that Alberta will be, and Calgary per se, because it is one of their stronger cities to invest in. I do think it will be a bit of a shining star, but it's one of those things where if you look at, for example, Vancouver in 2008, 2009, no one had any idea that when the financial crisis hit, it was only going to be a bit of a blip here. Like it was 2 or 3 or 4 or 5 years in other areas between 2008, 2009 to 10, 11 or 12 in other provinces, other cities, other states. In Vancouver, it was like 8 months of really negative downward pressure, downward kind of doom and gloom reporting, downward expectations, kind of tapered expectations. And then there were the investors or the developers who started to look at opportunities in Vancouver. And 8 months, kind of 8, 10 to 12 months, things started to recover. So I do think that Vancouver will be strong, hopefully sooner than later. That's just a personal opinion. I do think Calgary will, Calgary has legs as well. I think that hopefully in the near term, when you see the economic recovery in Canada and when you see gas starting to normalize a bit, because right now there's a lot of different sectors that are being affected right now, and it just seems each week there's a new news clip that comes out that's just more and more negative. I do think that when oil and gas does come back, which I think it will.
Yeah, just a comment on that. So Alberta shale is trading at negative, right? So that means they'll pay you to take the oil away from them currently. So it's crazy times over there for Alberta. But go on, Troy. Also, yeah, just speaking on that as far as Vancouver and how we were kind of in a way protected when the world economy pretty much crashed in 2008, especially the US economy, and Vancouver just went flat for a while. The prices didn't crash. Nobody lost their shirt over here. And that is mainly because the real estate market is very much foreign driven. Foreign investments are happening here. And my prediction, and totally, again, this is a totally prediction, is that this situation happening that all started by all the experts in China is going to drive actually people wanting to move to countries like Canada. So I mean, we got great things like free healthcare. People are going to be much more health conscious. They want to live in a place that is very much systematic. They're that they're going to be taken care of. So I believe, my opinion is that there is going to be a influx in immigration into Canada coming. And so that's definitely going to affect the real estate market here locally. Also, another prediction I have, and this is not purely from me, but I've overheard it spoken a lot of experts about this idea that people are going to start wanting to move away from high density areas back into the suburbs, because what we've seen in the past decade is that migration of people moving from the suburbs into the downtown core, into the high density areas. But now, as a result of the COVID-19, people actually might make the opposite return of wanting to come back into the suburbs where me and Troy live. So just wanted to throw those items there. But go on, Troy, please.
I mean, like I was saying earlier, I just think that if you look at various cities and even, I'll just speak to one last thing and then I'll be done my little soapbox spiel here. Even if you look at the States, previously we were looking at trying to purchase properties in Oregon for development purposes. It can be a challenge when you're looking at another province or you're looking at another like jurisdiction or another state to work into. I think overall right now where things are at, like if I can just kind of summarize some of the things I've just briefly mentioned here, I think now even though it's a kind of a strange and turbulent times, or it's a strange and turbulent market, in the next 3 to 6 months, just because of where we're located and the potential investment.
Oh, you froze there, Troy. Let's see, where's Troy?
With other other players in the market looking to purchase development sites, just like what happened in 2008, 2009. So I think within the next 12 months you're going to see some major transactions taking place, or major transactions being brokered locally. And also, like when you look at an Alberta perspective, at the end of the day, as soon as there is some positive economic indicators in that province, I think you're going to see a lot of activity taking place as well. Just to kind of, the one last anecdote I'll say before I'm done, done speaking on things. If you look at America, like when we were looking at sites in Oregon, we were actively looking for a multifamily development site out there about 2 years ago, 2.5 years ago, something like that. And when you're looking to invest in a foreign jurisdiction, we're looking to do multifamily apartment site. The investment side of things in America, and the kind of lending criteria and the currency swing, those are some of the things that intrigued us. There was some risk involved in that, and there was some reward involved in that too. And what I found interesting about trying to work in the States is that they're very developer friendly out there, and they're very
the US is totally different world. They're very business friendly, very also some states there's no state tax. Tax items, the 1031, where you can roll over all the capital gains from one project into next, as long as you do it within a year, and as long as the project you're purchasing is the same value or higher than the last project you sold. So the US is completely different animal than Canada. But a quick question about what you're talking about, Oregon. As a developer, again, I enjoy having this the large developer perspective. When you guys look at your development project in Oregon, was it a rental, or this was you guys were going to sell the units?
We were looking at both options, either rental or to be able to sell it.
And on the rental, is this idea of the occupation demographic of potential tenants, is that something comes up? Because the reason I get into that is we were following the numbers. We were looking at assets in Texas, West Texas, because of the energy sector. We were looking at assets in Arizona because of the tourism sector. And now these are the sectors that are hit the hardest. So I have the deals I'm looking at currently are deals where 60% or more of the tenants' occupation is in the healthcare world, in these healthcare hubs in Texas, that people are either working in hospitals or research centers and what have you. So as a developer, is that something that you guys focus on to see what who you're building for? In Vancouver, we've heard about big companies coming in, the Amazons and so on. Is that something that you guys focus on? Was there a reason where Oregon started being attractive to you?
Yeah, and that's what I was. You kind of hit the nail on the head there. With regards to why we were considering purchasing a property in Oregon, there's a huge university segment out there. They have some of the top schools. They have a huge student base out there, and they have some of the top talent out there as well, just in regards to Portland, Oregon. It's a very interesting city to visit, and it's also a very interesting city from like an economic fundamentals perspective. And at the same time, they have a huge, like professional, doctor, nurse, medical, medical field out there as well. So when you combine the opportunity for there to be like a strong student base, strong university base, and then you combine the opportunity with a strong healthcare base in terms of the demographics, what the population of the city, and you look for a site, or you're looking for sites that kind of are nearby both nearby universities and nearby some of the, the healthcare areas, you can find some interesting opportunities out there. The only reason why we didn't proceed working in Oregon was because we're concerned about currency swings. Is at that time, the dollar was a little bit volatile, so obviously you have concerns there. And then at the same time, the only reason why we didn't proceed was we were dealing with the planning department out there, and we were hoping that we were going to get a little bit more density on the site, than the plan had called for. So just trying to push the envelope a little bit. And unfortunately, we couldn't get as many units on the property as we had liked. The city was wanting us to do kind of like stacked townhouses. We wanted to do a kind of a 4 or 5 story apartment building, put a bit more try to, maybe add 30% more units than the city was comfortable with. So we were trying to be a little bit more aggressive, but we figured it's the States, and sometimes they're a little bit more flexible in their approval process. But unfortunately, we couldn't make the numbers work at the end of the day when we're working with the city. But there are some places in the States, and there are some opportunities out there that are very attractive. I just wanted to throw that out there as just an interesting anecdote.
No, for sure. No, I appreciate that. And I appreciate all the knowledge and wisdom. And well, Troy to get an appointment with Troy, you had to book a great sushi restaurant to be able to pick his brain. But now you guys got an opportunity to meet him over here and for him to tell us a little bit about what he's up to. So if you'd like to share your LinkedIn or your information for people to get in touch with you, go ahead. Amit has already done that. Now I'll roll back around and quickly discuss some other items. So again, I mentioned this earlier. This meetup is this meeting webinar that we have today is part of a meetup that I hold once a month on the first Monday of the month. It's mostly about investing in US multifamily, but I thought I would bring on different experts to kind of give us an idea of the local market. I'll speak about the US market a bit and moving forward for everyone, but this is just so you guys know what this meeting, what spawned the meeting and how it was about, how did it come about. So if you'd like to join the meetup group, I can put a link to it for everyone in the messaging platform, or you can message me later on and I will send you a link to the meetup group that we have. And moving forward, I guess definitely our world has changed. So I'm predicting a lot more meetings to take place via Zoom and online platforms. This is going to be a common theme. So quite possibly our next month's meeting is also going to be on this platform. So I would love to have you guys on board. For the people who are not very familiar with this syndication process, I quickly want to go over what apartment syndications are, so you kind of have an understanding, and we'll just call it a day at that point. If anybody has any questions from me, please go ahead and write it down, and I'll try to get to it. But I'll quickly go over what is the idea of syndication and our whole meetup group that we have and what we discuss. So apartment syndication are basically a process in which a sponsor, a syndicator, for example, myself, raises capital from investors to purchase multifamily apartment communities. We look at apartment communities that are 100 units and above. In this way, we lower the risk. For example, if you own a fourplex and one of your tenants move out, 25% of your tenants have moved out. If you own a 100-unit building and 5 of your tenants move out, you only 5% of your tenants have moved out. So it's kind of a hedging your bet when you look at multifamily. I mean, in a lot of different aspects, it's very helpful. So what we do, we obviously our criteria has totally changed now with the COVID-19 situation. So we're looking at the market very closely. We've stopped all acquisitions at this time, but we are looking at deals as we move forward. And yeah, that's kind of a bit background about myself. So if you'd like to learn more, please get in contact with me. Check out our website, CanadianPassiveInvesting.com, and keep in touch for next time for the meeting. It's going to be next month on the first Monday of the month. So keep in touch, and if you have any questions or comments, please go ahead. I want to thank our speakers for coming on and speaking today. I want to thank everyone who came on and dedicated an hour of their time to be on this webinar. I appreciate all of you, and have a great rest of your evening, everyone.